Good afternoon and welcome. You're watching MF Corner. I'm Sumera Abdi. On the show today, we're going to talk about how to invest in volatile markets. Everybody's wondering, the Nifty is at 12,000. Why isn't my portfolio going anywhere? So we'll have Anshu Kapoor, Head of Private Wealth Management at Edelweiss, will be joining in to talk about what we should do in this environment. And a little bit later on the show, we'll be answering all the viewers' queries that have been sent in. And joining in will be an old friend of the show, Nikhil Kothari of Erica Wealth. Well, first up, let me invite Anshu Kapoor, Head of Edelweiss Private Wealth Management on the show. Anshu, everybody wants to know the market is doing well, the economy not so much. Where does the fate of their portfolio lie?
Right. Good afternoon, Sumaira. Great to be back on your show. Yes, that's a very pertinent question, and personally, we've been asked this a zillion times over the last couple of months, as in what explains this dichotomy that Nifty is making new highs, and when investors see their own portfolios, they're nowhere close to feeling the same kind of euphoria. And the big question, Sumaira, is about tackling volatility. How do you tackle this wild swing and sometimes very painful swings in the markets? So what can investors do? And I just want to start by kind of reminding investors as to what kind of returns Nifty has given over the last 3, 5 and 10 years. So Nifty in this period has returned about 3%, 7% and 8% respectively. I don't think that is something that most investors expected from an equities point of view. But if you notice the ups and downs, the best 12-month period for Nifty would have been about 45% up, and the worst period for Nifty would have been about 25% down. So how do you navigate all of this volatility and be able to keep your calm, keep your portfolio intact, and at least take some money home, take some money off the table? I think those are the few questions that are very pertinent, and this volatility is going to persist. I don't think it's going away in the near future. So here are my some pointers on volatility. Number one, I think we need to focus on absolute returns and not benchmark returns. Our portfolios, our objectives are not linked to Nifty, and if we have defined goals or expectations from the portfolio, as soon as we are starting to come close to those goals, have a planned exit policy. Do not wait for that magical threshold to cross and say, hey, now I'm going to exit. So I think planned exits and focus on absolute returns is very important. Even in these times, if you made that 5-10% in a quick rally, maybe it's time to reconsider as to how much you should be invested in or what you should do with that investment. I think the second point, and it's very important for investors to understand, is the concept of what let's say banks call asset liability management. Do not put 3-month money in a 10-year product. So do not make that mistake, because that really hurts investors. In the times of drawdowns or in times when you need that liquidity that is not available or it is not priced well, you do not want to sell it. So that's the second strategy we would recommend. The third strategy will be to diversify, right? India is only less than 2% of world market cap. Now there are great products available for investors to enter international markets. So these are some of the tools you can deploy to deal with volatility. And there are other thoughts I have, but I just want to hear your thoughts on this.
Well, I take your point, Anshu, entirely, but I'm just wondering, because I thought the whole effort was to try and tell people that don't look at absolute returns, because if the market hasn't done well, how do you expect your portfolio to do well? So if you could just explain why you think investors should be looking at absolute returns.
Yeah, I think see, one we all get carried away, I think, both on the downside, on the upside. And let's see, if you were invested in an IT fund, and in the last couple of months, IT funds would have given you, 15-20% returns. And I think if your return expectation from equities itself is, let's say, 10-12%, it is time for you to consider to exit and maybe wait for a more opportune time to be able to enter at a better time. So that's all I'm saying about absolute returns. And all this, the second point, I think a bigger point I wanted to make is, as interest rates decline, the market levels or the price to earnings will change. And that is what something investors have to come to terms with. It's not an easy adjustment because we've always lived in a high interest environment. And when interest rates are falling, along with liquidity, that is creating this environment where the price to earnings will expand. And what you may feel uncomfortable investing in this environment, I am asking you to reconsider that approach and be disciplined about your investing even in these times.
Okay, so then what do you do in a low interest rate environment, right, which we're seeing? What would the top recommendations be? I mean, start off by lowering your return expectation for sure.
Yes, definitely. And that's a big point, Sumaira. Thank you for bringing that out. Because if you expected equities, for example, to return about 12% or 10% post-tax in an earlier regime, now, given that we are at almost 12% low from an interest rate point of view, your expectations have to come down. You need to be now about post-tax 7-8% on equities. And it's very hard to digest for a lot of investors, but that's what I would recommend. Bring your expectations down. We earlier talked about locking in as much in AAA in high quality fixed income. And I think finally, again, coming back to the point that higher PE always, when interest rates are going down, not all companies get that benefit. In fact, the spread between the AAA and the AA is all-time high almost. So the weak are getting weaker. And this whole phenomena of market power, economic power, success being concentrated in a few companies is true. Is actually true. So do not get dissuaded by the fact that only 20 stocks out of 30, 50 Nifty are performing. Right? But that's a market reality, accept that. And therefore orient your portfolio. I would still say be in large caps. If you are not willing to take thematic calls, be in large caps. If you are conservative, be in 70% or 80-85% in large caps, but be there. Right? That is where the trend of the market is. So be there, accordingly take your calls, and do look at a lot of these other products that are available. I talked about international funds through a mutual fund route. By all means, look at China, look at US, look at technology in US, look at the NASDAQ. Those are all interesting ideas. There are pharma funds available now. So you need to be able to look at those opportunities as well when the rates are declining in our country.
Yeah, that's very interesting, Anshu, because, when I was seeing a model portfolio, it's not very often that we see people giving this international exposure as part of the core portfolio. You think it's about time now that people actually start allocating from their core portfolio towards these international funds?
Yes, definitely. And again, I keep saying, Chinese market is a $10 trillion market cap market. US obviously is about $30-35 trillion now. You cannot ignore, and a lot of opportunities that you can access in let's say a China or a US are today perhaps not available in India. Those companies are not listed. The Indian markets are not mature. For example, a lot of cloud companies are listed in the US, right? So how do you access that? And if that is the future? So I'm making this strong point because diversification is key to be able to navigate volatility, to be able to navigate all these correlation problems that happens, because finally in India, you are invested in one currency and largely invested in 3 or 4 asset classes. So how do you break out of that? I would argue strongly by diversifying.
All right, Anshu, thanks very much for joining in and for explaining that concept to us. So, there is a strategy to deal with the volatile market, and, like every cycle, you have to be sort of nimble-footed here as well. Anshu, thanks once again. A quick break. On the other side, we'll be answering the queries sent in by our viewers, and joining in will be Nikhil Kothari of Etika Wealth. Stay tuned.